Greetings. We receive a lot of emails and questions from our investor base around the world. And sometimes these are really interesting and well-formed and well-thought-out questions. And I thought it would be a good idea to share some of the answers that we give our investors with you in the form of a series of videos. So one of the questions we received from an investor recently, and I'm going to read it from him, went as follows. Why does a gap exist in the Aussie market? If loans are creditworthy, why would the banks not fund them? And if not the banks, why do borrowers need to pay such a high premium to find the funding? Does the short-term nature of the loan have a lot to do with it? That's a really good question, and I'm sure that many of you have thought it as well. So this is the answer that I would like to present to that question. So I think it's worth noting that that gap has always been existent in the Aussie market, but is now more prevalent. This is mostly owing to a pullback by the banks, which took a hammering post the Royal Commission into banking, which was about 18 months ago now. And prior to that, the banks were already under pressure from the regulator, mostly from APRA, the Australian Prudential Regulation Authority, to tighten lending into the residential sector, as APRA was of the view that a bubble was being created and that credit was loosening. The result of both the APRA pressure and the Royal Banking Commission is that banks have now narrowed their credit policies. They've added even more red tape to what was an already bureaucratic process. They treat borrowers sometimes with this disdain, but certainly with disrespect. And they have lost large parts of their franchise. Post-COVID, banks have become even more risk averse, focusing on managing their existing books and making it even harder for their existing customers to access loan funding. A lot of this has been in the form of changes to credit policies, which are really inconsistent and which can change quite regularly in various ways. So there's always been a healthy margin between the primary lenders, the big banks, and then the secondary banks, and behind them, the private lenders. Private money is obviously more expensive and comes at a cost, as it generally comes more quickly and obviously with less red tape. But that is not to say that private lending credit is necessarily sloppier. It's just that private lenders can make things happen faster and are more commercial in their approach and can take the decisions more quickly when required. As far as Zagga is concerned, and I can't talk about any of the other lenders, I can only talk about Zagga. Every borrower that we have is one that has enjoyed facilities from a major bank and in many cases has long-standing relationships in place with their bank. However, banks simply cannot reciprocate those relationships. If you look at recent loans on the Zagga platform in Tamarama, in Sutherland, in Miranda, in Newtown, each of these are to A-grade borrowers, in some instances top-class property developers who simply don't want to wait the time that it's going to take for their bank to make the decision. Time is money, and that is no less relevant to a developer, and the waste of time in waiting for their bank or in paying a higher rate to us is easily covered when they take the private loan and get stuck into their projects. Also, as to the question of creditworthy borrowers, just because a borrower is banked by a bank doesn't mean that they are necessarily creditworthy. I'm pleased to say that in almost 100 loans that we have done with almost $400 million out the gate, no investor has lost a cent. We really are very proud of that track record and will do everything that we can to keep it. Well, I hope you found that answer useful. If you have any more questions, please email info@zagga.com.au. We'll be delighted to answer the questions. And obviously, if I feel that it's one that has broader appeal, we'll certainly put up a short video to answer that. Stay safe, keep well, and take care.